Good morning, everyone. We'll give a couple more minutes here. Thanks for joining today. We'll give a couple more minutes for others to join, and then we'll kick this off. It's a beautiful day here in Southern California.
Same here in Charlotte. I think our high is 80.
Same here in Maryland. Beautiful day today.
Tom, do you ever work from that lawn chair behind you?
I love the backyard. I do. Let's see, pull up this screen. Oops, I don't want to be sharing. Okay. I think we're ready to kick it off. So, good morning, everyone, and thanks for joining us today. We have a really good mix I see online here of independent mortgage banks, chartered banks, and aggregators and investors. So it's really a well-rounded group. I'd like to keep this conversation practical and focused on how credit models actually get used in the real world. So let's start. For a long time, our industry has relied on fairly static credit snapshots. But as we all know, borrower behavior is not static. Balances change, utilization moves, and the payment patterns change. So the idea behind trended credit scoring is simple. That's what we're talking about today, the trended credit scoring. Instead of asking only where the borrower is today, we could start asking where that borrower has been heading. And that's the goal here today is really to educate the audience, not a product pitch, but just details about how credit information is changing and how it's becoming more available to lenders, investors, aggregators, and third parties. For those who may not know me, I'm Tom Farmer. I'm Chief Investment and Corporate Development Officer at MCT. And at MCT, we work closely with lenders and investors across the secondary mortgage market, helping them manage pipeline risk, capital markets execution, and servicing analytics. Part of what we've been doing recently is working with FICO to integrate FICO Score 10T into our infrastructure so lenders can evaluate it directly in their workflow. That includes in our tool suite, MSR Live, MCT Live, and the MCT Marketplace, where lenders are already managing pipelines, hedging, loan sales, and servicing insights. The idea is simple. If the score exists, but lenders can't see it inside the tools where they make the decisions, it's not going to influence anything. So the part what we've been working on together is to make those insights visible in the environments lenders already use today. So let me introduce our guests. Let's start with first Alyson Finn. Alyson, welcome. Alyson's a senior manager in FICO's Client Services Division. She works closely with mortgage originators to help drive adoption of FICO scoring models, including the newer FICO Score 10T. She brings more than 15 years of experience across the mortgage industry, including time as an LO, and in client relationship roles. She helps lenders implement and get value from these kinds of tools. We're also joined by Sabitha Thomas. Sabitha is a director on FICO's mortgage and capital markets team. And Sabitha works closely with investors, rating agencies, asset managers, and mortgage insurers to help connect FICO's scoring and analytics with how credit risk is evaluated in the secondary market. Before FICO, she spent more than a decade at Fannie Mae in capital markets roles. And earlier in her career, she worked in cash flow modeling at Standard & Poor's. get that right, Sabitha?
You sure did. And thank you so much for the warm welcome. We're so pleased to be here.
Right. So we really appreciate both Alyson and Sabitha joining us today. So let's start with the basics, and maybe you'll let me go through some questions and you guys can lay out for the audience the responses and FICO's answers. So we talked about how we've been relying on these static credit snapshots for many years. What was the limitation of that approach that led to the development of trended credit scoring?
Well, Tom, you actually alluded to it right at the top of the call. So for those of you on the call, our classic FICO score was developed in the 90s, right? And as you can imagine, in the last 30 years, a lot has changed, particularly when it comes to consumer borrower and behavior trends. Like I'll take one example for myself. All of us love to leverage our credit card points. And so for me, myself, like I'll, make some purchases on my points, rack up, that balance, and then pay it off in full every month. And that pattern is something that we weren't able to capture with our classic score. Our classic score is more like a snapshot in time. I kind of compare it, when I make this comparison, when I'm talking to folks, I kind of compare it to a photograph, right? A snapshot, a picture versus a live photo or a movie, right? And so the thing that's missing in the snapshot is like it's accurate for that point in time. It can tell you exactly where your balances are, but it's kind of missing that pattern and that picture. And by incorporating kind of those trended components, we get to have a little bit clearer picture of a borrower's credit risk than looking just at a standalone snapshot alone.
Gotcha. Well, let me follow that up then with when we're talking about that trended data, what are we actually observing in the borrower's credit behavior? And maybe a second part of that would be, what kinds of patterns are lenders looking at?
Yeah, great question, Tom. And we get that question a lot when we're talking to mortgage originators. With trended data, we, as Sabitha alluded to, since we're looking at more of a video perspective of the consumer, we're looking at them from a 2-year history instead of just that snapshot in time. But one of the things that we are often needing to make clear is, I'm often asked, Alyson, why is FICO score 10T more predictive than the classic FICO score? And why is it the most predictive score in the marketplace? Well, the big thing is it's not just the trended data component, although the trended data is definitely an additive to what makes it the most predictive score, but it's really an accumulation of all the enhancements that have come down the pipe with the newer score versions that FICO has put out over the years. Other industries like bank card and auto have migrated to newer scoring versions. Just in mortgage, we haven't, since we're heavily reliant on what the GSEs do. So if the man behind the curtain wants to share the enhancements at a glance, I think that's a good visual of really a summary of what makes FICO score 10T different than the classic FICO score. So as Sabitha already mentioned, 10T was developed on data that's over 20 years newer, which adds to its added predictiveness. The T stands for trended, as it incorporates trended data. We have we have improved authorized user treatment with 10T over classic. I never knew this, being a loan officer for 15 years, but with the classic FICO score, I was pulling all those years. It treats an authorized user account the same as a non-authorized user account. Well, common sense would tell you they're not the same risk weighting. So with 10T, we have a more appropriate risk weighting for an authorized user account. We also have improved collections treatment with 10T, where paid third-party collections are bypassed and medical collections are viewed less negatively than non-medical collections. We have the inclusion of rental data, obviously when it is reported to the credit file, and also improved thin file treatment. So again, as I mentioned, it's really 10T is an accumulation of all the enhancements that have come down the pipe, all bundled into one. And since it's on here, the biggest eye-opening thing that, when we talk to mortgage originators and really all stakeholders throughout the ecosystem, in our analysis, we've seen up to a 5% increase in mortgage application approvals, or
Wow.
a 17% reduction in delinquencies, depending upon the way you look at it. So as you can imagine,
What was the reduction in delinquencies?
17%, Tom, right there, smack dab on the lower right-hand corner.
I gotcha. There it is. I guess I'm not seeing the slide there. There it is.
No, I think, you know, understanding that it's all of these things bundled into one is an important concept.
That's fantastic. Great. Well, let's see, from the lender perspective, especially for some of these IMBs that are on the phone, that are operating in tight margin environments, and we know well, every basis point matters. How does the trended scoring improve risk segmentation compared to the traditional score?
You know, Tom, for all of the IMBs out there, risk reduction, risk mitigation is the name of the game, right? So Alyson just alluded to potential pickup of 5% in approvals, but a 17% reduction in delinquencies. And what that means is without taking on additional risk. And we're going to get into that a little bit more from like a modeling perspective, exactly how that works. But to be able to expand your credit box without taking on additional risk, like that's the message that Alyson and I are the most excited to be bringing to the marketplace right now. And honestly, with this score and, you know, that improved predictability power, it allows you as an IMB to make better credit decisions because it gives you more data on which to underwrite. So we talked about that movie as opposed to a snapshot. Like having that additional data, again, it gives you that clearer picture. So it could allow you to open up your buy box because now you can see trends that might have been missed in the traditional score. But at the same time, it can also potentially mitigate against some of those post-closing adverse events like defaults and or repurchases, right, which we know hit everyone's bottom line. And so again, having that more robust picture of a borrower's credit behavior contributes to that mitigation strategy.
I see. So, well, just so I'm clear on this, so with classic FICO, you could have two borrowers that had the same score, but those borrowers could be very different. And with the trending, you know, the 10T credit layer, the credit information on top of all that learned FICO experience over the years, is this where you can have two borrowers with the same score but very different trajectories and see that trajectory with the 10T? I might not have asked that question very well.
No, I mean, I think, you know, one point that we definitely want to hammer home is that once we arrive at a score, so you think of your classic FICO score today, one of the things that we want to reiterate from migrating from classic FICO to 10T is that we have not sought to put additional burden on the investor community or the lending community. We've kind of taken the heavy lifting out of that. And so what that means is that when you start to receive your 10T score, a classic 720 FICO is going to behave really similarly to a 720 10T score in terms of probability of default or probability, you know, of prepay. What really has changed with the 10T score is how we're funneling borrowers into that credit scoring band. But ultimately, once your credit score is assigned at that 10T score, it's going to behave exactly or very similarly, I should say, to what you are already comfortable receiving in terms of a classic score.
Great, thanks for that clarification. Let's talk about the other side of our marketplace. You know, so we've got the originators bringing loans to sell, and we've got the investors buying loans on the marketplace. The investor's perspective, you know, the credit models ultimately feed into pricing and buy box decisions. Does trended score improve predictability there? Does it improve predictability when you're evaluating the loan performance?
Yes, Tom, like 100%. Like the 10T score brings improvement at every step of this chain, right? So when it It comes down to what a borrower ultimately pays through the origination process, through, you know, the loan sale process, and ultimately for the end investor. The 10T score is going to be a superior product in terms of predictability at all parts of this life cycle. I know you mentioned at the top of the call that I spent some time doing cash flow modeling for both S&P. I spent some time at a broker dealer structuring deals. So I am no stranger to credit modeling and how that impacts pricing and valuation. And one thing I think that is really interesting about the FICO score here is, again, it gives you kind of a view into the risk, right? And so we talked about a little bit like how it does that, and I'll just dig into that a little bit. Like, the simple fact is that, you know, the trended data adds to the incremental predictive power of the score, making it more accurate. And so what it does is it pushes our highest risk borrowers further down the credit score spectrum and the lowest risk borrowers further up. If we can flash that slide, that it kind of shows the distribution. I just wanted to get into it just a little bit while we're talking about this. But essentially, you know, when you look at how classic FICO, you can see that stratification was kind of around like that 700 to 780 band, and that's where most borrowers would be, right? But what we see here with the 10T score, again, you see those dark blue bars, you see way more borrowers pushed up into the highest end of the credit spectrum. You just didn't see that with classic FICO. You can see there's barely any in that light blue pocket over here, but with 10T, we see a lot more borrowers, again, about using that trended data picture, pulling, like really identifying the true risk of that borrower and correctly pushing it into the higher end of the spectrum. And conversely, with our riskiest borrowers, you can see that those are getting also pushed down into the lower end of the spectrum. So really, when you compare these two distribution curves, you see a real flattening of the curve. And that, again, is just based on that credit risk profile being a little bit sharper with the trended data. Now, you know, I'll go into this example as well. Like with the classic credit, you know, static data, we can only see that current snapshot of a consumer's debt level, for instance. So for example, let's say they were 60% utilized on their credit cards. It's not great, but it's not overly concerning either. But looking at the trended data, it tells us they've steadily ramped up from 15% utilization just 4 months ago. Now that's more concerning, and it would cause us to push this consumer a little bit further down on the credit spectrum relative to someone who has had relatively stable amounts owed over the past few months. And then on the flip side, someone whose amounts owed are trending steadily downwards can be rewarded by a trended score, and that can cause them to be priced more appropriately again. So it really is about identifying, and that's what we mean by funneling who gets into these credit score bands. That trended data gives us that sharper picture. But once the borrower has been assigned to a particular score band, you can expect it to behave really similarly to what you're already comfortable with and have observed with classic FICO.
That's a fantastic answer. That's quite a lot of information and very good. And you know, it's great having a tremendous model, but just having the model doesn't solve the issue for the industry. You know, whenever the industry introduces a new credit model, adoption, it doesn't happen everywhere all at once. But we've seen a number of our lender clients and a large number of our investors and aggregators adopting this 10T score. Maybe you can tell us a little bit about it. You know, we've seen that already there have been, you know, securitizations on it, hundreds of billions of dollars in originations, and well over $1 trillion in servicing portfolios. Sabitha, maybe you can talk about what you're seeing from early adopters.
Actually, Alyson is right on the front lines of early adoption. She'd love to share on that one.
You're Alyson.
Yeah, I feel left out. That's me, Tom.
Yeah, my fault. Sorry.
No, I'm just kidding. No, yeah, everywhere all at once is 100% on the nose. But I think I joined FICO about 2.5 years ago, and really that was around the time where we started the FICO Score 10T Adopter Program, and it's so cool to say that we have almost 50 lenders that are signed up in the program, everywhere from the largest lender, Cross Country Mortgage, Cardinal Financial, Freedom, down to Michigan First Credit Union, BMO Bank. So we have a great mix of, IMBs, banks, non-banks, big and small, that are part of the program, and it really is available to anyone that wants to participate. But really, the concept with the program is we just want to start getting the new score, FICO Score 10T, into lenders' hands before the transition with the GSEs, to start comparing on their own production. Because before they migrate to a new score, wouldn't you want to see what it looks like on your own production? But also, once they have that score, they're starting to take a look how they can use it on non-agency loans. So, where one of the places we're seeing it first is in VA production. So Cardinal Financial issued our first VA loan securitization a little over a year ago. It was a VA pool that was decisioned on 10T, and it was very cool because it was military personnel that were able to secure better terms on 10T than they would have on the classic FICO score. So that's amazing. We're also seeing, I think, several other lenders that are starting to put out VA loans securities. Also, one of our top 10 early adopters is going to be putting out the first non-QM loan securitization later this year. Spring Q is going to be putting out the first HELOC securitization later this year. So 26 is a busy year, and we're really excited to see the traction. But really what the 10T adopter program entails is for lenders that sign up with us, they're able to get FICO Score 10T for free alongside the classic FICO score for 3 years. As cheesy as it sounds, I compare it to a BOGO. So when you're paying for classic, you get 10T for free. So like I said, you're able to get that on your own production, pull it in the background so you're not disrupting anything with your tech stack or whatnot, to start comparing it and see how it shakes out. Because we did see up to a 5% increase in mortgage application approvals. When you look at the Govy products, we see up to a 10% lift in VA. We see up to a 26% lift in FHA, but it may be different. That was on a national sample that we looked at. So we encourage lenders to look at 10T on their own production before they consider transitioning.
Excellent, excellent. And I know that we've seen a lot of activity around it as we've partnered with FICO and built the 10T into our workflow. On the servicing side in MSR Live for valuations, there's now the ability to enter in the 10T scores if you have that, and value your loans with that rescoring. We've also built it into MCT Live, so it can come in through the LOS, or if your LOS hasn't adopted the ability to integrate 10T, I know a number have, but if it hasn't yet, we can take it as a separate file into MCT. So those lenders out there that want to use that, talk to your MCT representative about that.
Love that you're taking care of your clients, Tom.
So bringing these things directly into the workflow really helps exactly, Alyson, what you were talking about in helping them evaluate this early and operate, to evaluate and operationalize these in their workflow. So far, in our experience, I mean, we've seen loans trade with the 10T and gotten some metrics back where some loans that might have had some LLPAs under a classic, maybe didn't have it under a 10T. So that it's almost like an arbitrage opportunity out there right now while people are adopting. But certainly interesting opportunities there. Where in the workflow do you see lenders first engaging the score? Is it? I mean, we've had a lot of demands on the rescoring, the servicing. And we've got a number of companies that now are putting it into their loan sale process, but it seems like that the pull comes from the aggregator side. As they start evaluating this trended scoring, what should they focus on? What should they focus on?
I think from like a lender perspective, it's step one to really start getting the score. So I don't know if you guys want to share, the man behind the curtain wants to share how to join the program, but kind of, I think one misconception is you continue to work with your reseller that you procure your FICO scores from. So if you're interested in starting, because this is a totally free program, the first step would, you could reach out to MCT if you work with them, and they can connect you with our originator team. And we have a conversation and share our cooperation agreement with the client. Once that's executed, we add the lender as a named lender to a special program letter at each of the bureaus, and then we inform their reseller, and they can start pulling the subcodes to be able to pull 10T in the background. I think one of the common questions we get is, you know, if the LOSs haven't built out technology yet to automatically pull in 10T along Classic, the big thing that we want to hammer home is that the resellers have built technology to pull it in the background so that it doesn't break things. So the thing that we ask the reseller to do, unless the lender has a proprietary LOS, they pull 10T via suppression or in the background. And then the reseller is able to deliver the 10T report to the lender on whatever cadence, whether it's weekly, biweekly, or monthly. And then it's up to the lender whether they want to store 10T in an external database, or a lot of them have been adding custom fields to their LOSs, and then they're doing bulk uploads to the LOS. And like you said, Tom, you guys are amazing and can pull in 10T whichever manner that, you know, the lender finds most efficient, whether it be through that custom field in the LOS or through a flat file that you guys send to them. That way, you know, 10T is flowing into MCT Marketplace and the hedging analytics systems. So yeah, that's kind of like the operation flow. But the nice thing is we've been doing this for 2.5 years. So we, you know, are able to walk the lender through what all the options are and let them make the decision of how they want to do it.
That's great. And I'm going to circle back before the end of this, just so that we, you know, can inform everybody on the call again, how you find out about the direct license program and how you engage with the FICO 10T now. But before we do that, I want to talk about the elephant in the room. You know, many of the people on the phone call are seeing tweets and watching the agencies pretty closely before they're making major changes in their workflow or you know, how they're thinking about various credit metrics. So this is kind of a loaded question, but how should lenders think about what's actionable today versus what depends on agency milestones?
Yeah, I'll take that, Tom. I would say it really comes back to our program of be ready before you're told you have to move to a new score. So be an innovator, be a first mover, start getting the score, see it on your own production before you have to move to a new score. One of the industry updates that we like to share and we're very excited about, in early December 2025, we did publish a blog that we did come to an agreement on the terms and conditions with the for the 10T historical data release, the 50 million record file. So that will be released soon. I think we do like to make it very clear that that is not in FICO's hands. So we are waiting on that data to be released. And then also we came to an agreement that 10T will be accepted alongside VantageScore 4.0 with the GSEs. So that's great news at all, because because obviously lenders cannot handle multiple steps in this credit modernization initiative. They need it to happen concisely and in a way that makes sense. But I think coming back to like how to be ready before the GSEs make a change is start getting the new score on your own production so you can compare, and then start seeing how you can leverage it on non-agency business. You know, because if there is a lift, and if you should see some more approvals, then don't you want to take advantage of that? Because every additional loan booked is an additive to your bottom line.
Yeah, no, that makes great sense. And a lot of the folks that we have on this call are early adopters, and are interested in figuring out how they get ready before the starting gun fires. But it sounds like that's imminent, and so we should all be focused on adjusting our workflow. So let me end. Well, let's see. Before we wrap it, I did want to go back to just on the direct license program, just to wrap up for the folks on the call. Very simply, if you're a lender and you're currently getting the score from getting your FICO Classic score from a tri-merge, how do you get the 10T?
Yeah, that's a great question, Tom. And you know, something that I didn't know before I joined FICO is how this credit score changes hands. I thought, oh, the credit score comes from FICO and it comes to me directly, and that's really not how it works, right? So for those of you who are lenders, you work with your reseller who gets that score from the bureau who has a license to run our algorithm on-prem using our technology. So as you can imagine, every time that score changes hands, there's a markup. And something that Alyson and I hear all the time while we're on the front lines is, how do I bring my costs down? It's really expensive for me. Well, FICO's response here is we've opened up the distribution channel for who is allowed or a license to run our algorithm on-prem. Currently, you know, or at least prior to making this announcement, it was really limited to the 3 credit bureaus who had exclusive access to be able to run our algorithm. Now we've opened it up to the credit resellers. We've signed several of the largest credit resellers already to this program. But what that means is that you working with your reseller directly, nothing should change on your end if you already are working with a reseller. But now that they have the ability to run our algorithm on-prem and distribute it to you directly rather than relying on the credit bureau.
Fantastic. Okay, well, you can always contact any of us as well with questions, and you know, contact your MCT representative if you have questions about working it into your MCT workflow. So let me wrap up a little bit with a summary on some of the things that we covered today. First, you know, it's the general move of credit measurement, and it's not just a switch. It's not a forklift upgrade. It is all of the know-how that FICO has built up over the years, and then this new layer of trended credit scoring that goes on top. Credit measurement is moving from this static snapshot towards a behavioral view of borrower risk. And this trended data helps lenders and investors understand how borrower credit profiles evolve over time. Adoption will happen in stages, but it's going to happen fast across the mortgage ecosystem. And through our collaboration with FICO, we've been integrating FICO Score 10T directly into our platforms, MSR Live, MCT Live, and the marketplace, so lenders and aggregators can evaluate it in the systems that they already use. So I just want to wrap up with something kind of fun before we do it. We thought we'd have a little fun with the idea of foresight in capital markets. So Alyson, Sabitha, let me ask you one question. If you had a mortgage capital markets superhero alter ego, what would your superpower be? And maybe we can throw up what it might look like on the slides.
Oh my gosh, this is so fun. If anybody, do you guys feel like the entire mortgage industry gets their news from LinkedIn? So if you're on LinkedIn, this is where we shared ours. But Tom, I don't think you have yet to share yours on LinkedIn, but
Yeah.
it's not too late.
We're gonna hold you to it, Tom.
Well, you know, I think you guys are maybe good at predicting borrower behavior or spotting risk before anyone else sees it, or maybe something completely different. I'll show you mine. Go ahead and put it up there, David.
Oh yeah, no, he's got it up.
We got it up.
The capital markets dreamer. My
Oh,
superpower
really
is
good.
seeing patterns in the mortgage market before anyone else does, not by staring at spreadsheets all night, but by dreaming. Lots of sleep. While the rest of us are sleeping, the capital markets dreamer is connecting borrower behavior, credit trends, and market signals, and waking up with ideas about where things might be heading. And I know you guys have gotten some late night emails from me, so you know.
And weekends, don't forget.
Well, guys, I want to thank you all for joining us today. If you have any questions, reach out to Alyson, Sabitha, me, or your MCT representative. If you're buying dinner, reach out to me. Thanks, everybody. Great job.
Thank you so much for having us, Tom. It was a pleasure to meet with you and to kind of present this data to our clients. This is our job, our focus. So if there's any questions that we didn't have time to get to today, contact your NCT rep, just like Tom said, and happy to put you in touch with us to do a deep dive with you on anything that you might be curious about.
So much fun doing this with you guys. Thanks. We should start a regular podcast.
You took words right out of my mouth. Also, you didn't let me show how my superhero is.
Oh, there's Bruce. Oh, I cut you off and you didn't get to describe.
I know.
Okay. Just a teaser for our podcast that we're about to start.
Oh yeah. Sign us up, episode 1, Tom.
Those of you who don't know, our family's a Guardians of the Galaxy fan, and that's why I picked Gamora as my superhero. And so Baby Groot, this is actually my daughter's, but yeah.
So cute, so cute.
What
about you, Sabitha?
Oh, mine was Storm from the X-Men. I grew up watching X-Men, so ChatGPT named me Credit Storm.
Is that a good thing?
No, I have foresight into the data, like that comes up with a forecast of like the credit weather patterns or something like that. Anyway, I loved it.
And so have we ended the webinar now, or is this?
No, it's still going.
Okay, okay. So there's all extra information for everybody on the screen. I think that we're done now, though.
Yeah. Thank you again. It was a pleasure.
All right, it was a pleasure, Tom.